Alrighty, welcome back, Outfunners. It is a very terrific Thursday on the stock market. I mean, we're just grinding higher. That's all you need to know. Yeah, I mean, that's about it. We're looking pretty good. Not really too much happened yesterday afternoon. A little bit of a pump there towards the end of the day. Nice gap up here today on the SPY, and the Q's really got a good one as well. Yeah, the SPY gapped up roughly 2/3%. Kind of just been in slow grind mode kind of all day, especially here last hour was particularly kind of ramping up there. We'll see if we hang around the daily highs that we just put in, or if we do see a little bit of a pullback as we go into close today. Not going to be my bet. I don't bet against momentum. You really got to see things change direction before you kind of take those kinds of bets. Anyways, Qs. You can see the Qs. I mean, gapped up. They were even strong. They were stronger in the first half of the day than the SPY was. Looking pretty good there. So, yeah, that's how things are kind of going here today. Qs, they did gap up roughly 0.8%. Looking pretty good there. All right, IWM. Yeah, looking very good. Very strong. Kind of getting through that 205, 206 level. Very nice gap up here. Why the market gapped up today is your guess. Roughly a 0.75% gap up here on the IWM. But it hasn't really done too much today. You can see it kind of just chopped sideways throughout the day. DIA, gap up, chopped sideways throughout the day. What do we got here? RSP, clearly all-time high territory. There you go. RSP gapped up 0.6%. Looking pretty good. At the daily high. Not as strongly bullish throughout the day, but did just put in a new daily high very recently. All right. See how the daily looking at. RSP looking really solid. Look at that gap. Ooh, look at that gap. Very solid. DIA, still basing out. UNH has been really kind of, holding this thing back over the past couple of weeks. Looks pretty good today, though. Or it looks pretty good to be pushing, maybe continuing higher as it's pulled back. The IWM, yeah, it's starting to, man, it's looking better than what it was back on March the 4th on Monday. When it kind of got to this price level, but it faded back down, especially continued that on Tuesday. I mean, it looks pretty good for now. It hasn't been faded yet. So, yeah, I mean, the IWM is starting to look a little bit better. Qs, though. Qs and SPY, I mean, just absolutely motoring today. Qs are up 1.8%. I mean, that's a strong day, especially when we saw how weak it was. Even today. Even starting the day, pretty good gap up, but compared to the SPY, I mean, the SPY was hitting all-time highs early on in the day, and the Qs, I mean, it looks like Qs just recently got to new all-time highs within the past, 10 minutes, 10, 15 minutes, something like that. So, Qs did get on its horse today, but kind of overtaking a lot of the sell down that's been happening earlier parts of this week. And that's why you continue to buy the dip until we get some triggers to say don't buy the dip. AAPL. Oh, let me just go ahead and I'm not gonna plug anything, but I'm gonna plug something. One thing that was kind of interesting is I watched this this video. It's from Risk Reversal Media. It's a couple of guys that mostly do it. That are on. They're CNBC guys. Anyways, this episode, I'll put it in the link. This episode was very good. This was three guys. If you've ever seen the movie The Big Short, it was those three. There was three guys from that. See that? Let me see if I can get a picture. There we go. These three guys. That movie was about. Or their characters were in that movie. Anyways, it was actually a really good, interesting listen to this. I listened to this morning. I think this came out yesterday, or they did it yesterday. So, anyways, I'll put this down below. But one thing that was kind of clear, and I do not mind getting information from people. I don't always agree with it. I don't always look up information, but I do like this group of guys. From the Big Short movie, the real life people. They had a great story, right? They had a great story, and they, they just they're level-headed guys. They brought some interesting perspectives to kind of where we are now in the market, and that kind of stuff. So it's a worthwhile watch. But one of the things that they do actually talk about in there, I'm going to hit this real quick, is the market doesn't seem to care too much about really anything, especially when you continue to have debt continues to go higher. And it's something that I kind of mentioned last week. It was really kind of interesting that they actually just did this podcast, because that is a video I did last week, or we talked about it not during a video, but during one of the live streams, and I just turned it into a video for the daily wrap up. But let me see if I can find it again. U.S. government debt to GDP. There it is. So the U.S. debt to GDP levels, if you haven't been aware of this, like, we're at all-time kind of records, even going back to when we ended World War II. So that just kind of tells you kind of the historical level we are at. And some of the things that they do talk about in there is like, they don't like it, but there's a difference between not liking something and understanding what the market's reacting to. And basically the market's saying, yeah, we don't see you guys stopping spending on debt. And that kind of leads then back over to two things. It's going to be yields. We'll get into yields a little bit later as we kind of, do the daily wrap up and take a look around the market. But it's going to come down to really the main one. It's going to be jobs, and that's tomorrow. We're going to get jobs data tomorrow. I'm not saying tomorrow's jobs data is the pinnacle of information that we need to see, but if you are going to ever have a point in time when that debt to GDP number that we were just looking at becomes just stupidly, extravagantly, just blow off the top, kind of like the stock market does, that would be because the denominator gets screwed up. And why the denominator on the debt to GDP number gets screwed up is because you're having economic contractions, which means you're having unemployment is probably ticking higher. So that's why unemployment number is very important. And really, kind of been thinking about this recently. I don't like the debt to GDP number because GDP is not exactly an income metric. And that's it's kind of tough to explain because I haven't really fully thought this through, but I just don't like how you're trying to compare something that you have to pay interest on, which is debt, but GDP is not exactly an income number, right? You got unemployment rate and things like that. So if you do see unemployment rate tick higher, that would be, a reduction of income into the government because that's less tax money. So to me, that is the number to watch, is unemployment. If unemployment ticks higher, we would probably wind up seeing eventually the jet to GDP number tick higher. Those numbers are updated less frequently than unemployment, especially the GDP number. Those are quarterly. And if we do see then eventually that GDP number drop, that would be an issue. But the fallout would be not from unemployment going higher, would be the yield number. And we'll get into yields when we get there, because the yields would really start pushing higher. And I think that would be a catastrophic issue, not just for the U.S. economy and government and issuing debt and all that, or economy, yeah, the economy and all that, but just for the stock market, because as we know, the stock market wants cuts, and if yields go higher, they're not going to get cuts. Anyways, we're going to continue on. AAPL definitely has had its breakdown year. Kind of mentioned this 2 days ago. You don't want to be bearish at these levels. If we break through these levels, okay, then you're going to look for the retest probably into this level, or just probably be bullish on a breakdown because it'd be a pretty rapid breakdown. But for now, yeah, I mean, don't be bearish in this zone. Microsoft looking like it's having a pretty good day from a little bit of a bounce back day, a little bit lower hammer there yesterday. Huge sell day there on Tuesday. Alphabet bouncing back a little bit. Okay, so bouncing back. Oh, they were up over 2%. Meta continues to just be bullish because it's Meta, up 3.5%. It's been up higher than that. Got up to like 520 today. Looking really good there. Amazonian, looking pretty good. It's up 2.5%. Like, there's not much of a reason why I can tell you why all this is bullish today. Up 1% there on TSLA. Nvidia. I mean, Nvidia's up 4% again. It's just crazy there. VIX, what's the VIX doing? VIX getting crushed. A little bit of a higher open, pulling back down today. Okay, VIX looking pretty good. Dollar dropping off today, continuing that breakdown that I had yesterday. Gonna get into that. Mid 102 to 103. Well, it got below 103, but if it gets below the 102.50 level or the mid 102 level, then yeah, we're probably just looking to come back down. Then you're going to be bearish on any kind of pops, in my opinion. We'll see. It's in its move, so it's in its bearish move right now. GLD, new all-time highs on gold again today, looking really good. Yeah, not much else to say. GLD looking really good. All right, so yields. All right, so let's talk about yields. So talking about that, we get that unemployment rate tomorrow. If we see unemployment ever tick up here over the next month, 2 months, even a year, even over the next year, whenever it happens, I mean, with how high our debt to GDP is in the U.S., it'll put such a significant strain on that debt to GDP number to go higher, which is a number that all bond investors watch for government bonds. The debt to GDP number is massively important. It tells you exactly how much debt you can take on for your income, right? Or it's supposed to. I mean, that's the idea. And if we see unemployment tick higher, that means there's less revenue coming in, which means you're probably having some contraction or non-growth periods, maybe at least non-growth to maybe contractions in the economy, which means your GDP number is either flat or declining, which means, our debt would be going higher. So our debt to GDP number would go higher, and it would go rapidly higher if we actually did have a contraction in the economy, if our GDP did go down in the U.S. That is something that the bond market, the yields that you would see would absolutely climb very rapidly. Now, that's talking about yields on that previous point. As far as today, we got this little bit of a trend. You also got this little bit of a trend. with how deep this was, I wouldn't really say that either one of these are a trend. What is interesting is we do have a little bit of a lower hammer today. So if we do have a trend with these lower wicks here, and maybe that is the bottom for the week, and maybe GDP or jobs data is not great, and we see yields tick higher tomorrow. This might be the bottom of this little bit of a pullback that we had here over the past couple of weeks, and maybe we'll see yields tick back higher. And until we get the data tomorrow, it's not really my position to say if that does happen or not. A lot of people have been looking for unemployment to tick higher, and not to say that it hasn't. U.S. unemployed. Yeah, there you go. Not to say that it hasn't ticked higher. There we go. So throughout 22, it came down. Obviously, we're looking really good on employment. Everybody was getting back into jobs and stuff like that from COVID. Then it kind of just based around 3.4, 3.6. Last year around May, we saw it start to turn up from this basing action that it did for the second half of 22 and the very beginning of 23. And we actually saw this move higher up to like 3.8. Now, I think there were some issues actually with the data here because of the auto strike that happened last year at about this time. So I actually think this rise here was when the auto strike actually took effect, and then this drop off was when the auto strike actually kind of ended. So, but you can still see that we're still kind of trending higher. It'll be interesting to see if we do get a lower unemployment rate or a higher unemployment rate. I'm not super pessimistic, honestly. I think unemployment might be okay for now. I mean, the CHIPS Act that was introduced like 2 years ago, back in 22, August of 22, like there's a lot of manufacturing kind of going on right now. There's a lot of semiconductor plants being built in the States. And there's there's some good stuff kind of going on. So it's hard to see where unemployment kind of comes from right now. Not to say that the semiconductor plants provide all aspects and benefits of economic activity for the country right now, but yeah, I mean they are holding things together. Now, the thing I will say about those semiconductor manufacturing plants that are being built is later this year, they start to finish and actually come online. That's the difference. Once those plants are done being built, which, oh, you know what? It might be in the Discord. I might have put this in the Discord. It's actually a very interesting. Oh, yeah, I did put it in the Discord. Pfft, look at me doing things. Yeah, I mean, this is put out by Statista, or sure. But this is just a quick look at all the different kind of projects that are going on out there, and kind of when they're expected to come online. So you got completion dates, and I mean they go all the way up to 2026, 27, 28, that kind of stuff. We got a couple TBDs out here up in the New York area and Indiana. Is that Indiana? Yeah, Indiana. But as they come online here over the next, looks like most of them will be online by 2026, because the Samsung plant, which I drove by this past like 2 weeks ago or the past week, this Samsung plant was huge. It's on the way to my aunt's and uncle's ranch, and I hadn't been by there in a couple of years, and I was like, holy cow. So it was kind of nuts. And then you got this one out in Arizona, Intel, going to be coming online. So yeah, there's a lot of these projects that are going to be done here over the next at least 3 done maybe this year. We got Wolfspeed over here in North Carolina, so that's like 3 done this year. We got next year, we're going to have TSMC, Texas Instruments, Micron. So that'll be 3 done next year. And then in 26, we're going to have, Texas Instruments again, EMP Shield, Intel. So that's 3 that year. And that looks like the majority of that. And then after that, it's kind of iffy on what comes after that. And obviously we got the 3 up here kind of in the Rust Belt, New England area, but after that there's not a lot. So it'll be interesting to see just how much, as those plants start to come online and a lot of the production materials, labor that goes into building those plants ends, what kind of happens with unemployment, or even starts to wind down as some of those start to wind down, So, and this isn't just in America. This is all over the globe. Like Japan's building a bunch of new ones. Europe has gotten heavily invested back into building semiconductors. So, semiconductor plants. So yeah, there's a lot of this kind of going on around the world. The race to build semiconductors. So, if there's something that's driving the economy right now, it's not just semiconductors, it's semiconductor manufacturing. So there you go. Anyways, just wanted to kind of bring that up. That is probably something to watch. I mean, when does it turns over into unemployment after some of those plants get built? I mean, who knows? We'll see when we see, I guess. U.S. 10-year yield, a 2-year yield. Yeah, bouncing back pretty good today. It looks like it took a little bit of a low. Took that low that we put in 2 weeks ago. Okay. Still kind of basing. Kind of mentioned that I think this will probably have a prolonged kind of downtrend base action. This might be the kind of like the base bottom mean area. Kind of have this double bottom here. So I'd be curious to see what happens over tomorrow and Monday. So that's kind of what we did back over here, right? We had this little base, we had this pop, and we kind of rolled back over. We kind of came down, based again. That's kind of what we did, right? We based, popped, rolled back over. So we'll see what happens. But if unemployment starts to tick higher, yeah, that's going to throw a wrench in a lot of things. HYG not doing as strong today as you would think. Yeah, definitely not as strong as you would think. Right, because I mean yields are bouncing back. Let me take a look at the longer term 30-year yield. 30-year yield's bouncing. Oh, okay. This looks a little bit more definitive. Give me a sec. This looks a little bit more definitive. So yeah, that's definitely a little bit more definitive on kind of connecting in with these bottoms. So it looks like on the 30-year yield, definitely, people are definitely tracking this trend line here. So if we get through that trend line, we might definitely probably seeing yields on the 30-year, longer term yields, probably drop in there. Let's take a look at. I tell you what, let me. I'm gonna leave that because I don't track the 30-year all that often. So if I do come back to that here in the next week, be curious to see that. And then here's the 2-year. Yeah, and the 2-year had a nasty double bottom, here over the past couple months. We had this, drop here, bounce, came back down basically that same level in the yields, and then bounced hard again. Kind of pulling back very slowly and methodically into some of these highs, kind of that resistance top area. Maybe we'll see it bounce the yields off that level. But, yeah, there you go. The TLT, the U.S. 20-year Treasury bond ETF, kind of came up into this downtrending line, and that's kind of where we rejected again. Might not be, just saying, might not be a bad time to take a bearish, little bit of a position bet on bonds. Just because if unemployment does tick higher tomorrow, I mean, we'll probably see yields rip higher and we'll see bonds drop pretty pretty aggressively. And that's about the only thing I can say about it. I mean, even if unemployment's flat, maybe even down a little bit. I mean, I don't see yields dropping catastrophically lower. And honestly, I mean, I couldn't imagine them dropping lower because that's still not a reason for the Fed to drop and reduce interest rates, Fed funds rates. So, yeah, I think you'd be a safe bet being bearish on bonds right here for tomorrow's outcome on unemployment rate. Sector performance. Here we go. We got a nice little gap up here. Yeah, nice little gap up on the market. We got some pretty good bullishness out of materials to start the day there. But you can see, the tech areas definitely have been running hot throughout the day. So be curious to see what they look like without the gap. But yeah, XLC, XLK at the top in the tech, communications. Everything else is kind of underperforming. You got discretionary is kind of in line with the market, I guess. Materials, even though they had a very strong day to start the day, kind of underperforming a little bit there. Energy's a little bit underperforming. Industrials, staples, utilities, healthcare underperforming, and then financials and real estate really underperforming. And I thought financials got some really good news yesterday, but market doesn't seem to care what I think. If you take a look at the performance without the gap, you actually see that energies actually are doing pretty good. So apparently, I guess energies got hit with a gap down today, or not much of a gap up is kind of my take on energies. They're actually doing pretty good intraday. Tech, communications, yep, doing pretty good there. And then you got staples, industrials, materials, utilities, healthcare underperforming there. Financials, real estate at the lower ends of the day.